Hello again and welcome back to part 3 of Synergetics discussion about taxes and business. This is part 3 where we're going to talk about a few planning strategies that might be able to help us lower our overall tax liability, especially as it relates to our corporate taxes. In the last class, we talked a bit about credits and deductions as a general way that we can lower our tax liability. Here in this video, we're going to talk a little bit more specifically about a few very specialized tools that we can use, at least in the United States. I will say that many countries have similar structures and have similar devices that we can use, but each country has their own tax system and they are highly detailed and highly complex. So don't rely on this video for how to live your tax lives going forward. But instead, I think you could try to use these videos to start thinking about things to look into in your tax jurisdiction. But before we get started, my name is Jeff Keiser. I'm a lawyer. I'm a legal English teacher, and I love spending time with you guys. I love talking about language, how it works, and the law. I'm a bit of a nerd when it comes to that. Now, like I've said before, these tax classes are a little different because we're dealing with a lot of accounting principles as well. Now, I'm no accountant. If you're looking for an accounting lesson, then you should look elsewhere. But when it comes to the law, I know how these things work. It takes that kind of mind to work in the law, even in the tax realm. But I would say that if you need help with numbers, you should get a really good accountant, a CPA, or something like that, to really focus your strategies down within the law. And we're back for more taxes. I'll say it again, nobody likes paying taxes. It is amongst one of the more annoying things out there that we have to deal with on a regular basis, at least annually and probably even quarterly. It's no fun, but I'm doing what I can with the material we've got. Here we're going to talk about some strategies to minimize your corporate taxes. We're going to talk about the concept of GAAP, G-A-A-P, which is an acronym that stands for Generally Accepted Accounting Principles. And these are kind of the rules that work behind the scenes for the accounting side of things. Again, I am not your expert here. But when it comes to the law, we also have to think about statutory analysis, how we look at the tax rules as they've been published, how we analyze these things. But before we get too far into it, I've got another few terms to talk about as it relates to our vocabulary. Adjusted gross income. Well, we've already talked about what income is, right? But how do we adjust it? This is your income minus your deductions, your various corporate deductions, whether we're talking about employee benefits or other things like that, general business expenses. So you have your income and you subtract your deductions, and that's what gives you your adjusted gross income. A dependent. These are people that the taxpayer takes care of. In the United States, these are typically people under 19 or 24 if they are a full-time student. It also includes disabled people living at the taxpayer's house. Some other relatives, like a spouse, also qualify, as long as they're not working. We look at dependents in terms of how many deductions we can take on that personal tax form. So gross income. What's the difference between adjusted gross income and gross income? Well, gross income is all of the income that comes to us from all of the sources. If you remember, that includes even money that we receive from fraud or crime. I'm not saying I recommend that in any way, but it's all of our income. And we adjust that value to find our adjusted gross income by subtracting our deductions. Luxury taxes are interesting concepts in the law. They don't exist very much in the United States, but in other parts of the world, they are everywhere. If you go out and buy a Lamborghini or a Ferrari or some mega yacht, you may be required to pay a luxury tax on it. These are taxed only because they are non-essential and or accessible only to the super wealthy. Unfortunately, at least as far as I see it, those super wealthy people also have really great tax lawyers and really great accountants that really seem to minimize those luxury taxes as they have to pay them. Property taxes. Now, this is different than an income tax, certainly. If your corporation or if you personally own a home or land or other assets, you're probably liable to pay property taxes. And this is an annual fee assessed by a percentage of their value that you have to pay. I don't like them. I don't like taxes generally, but I think these are especially unfair. But nonetheless, I don't make the rules, right? A regressive tax is one where the tax rate goes down as the person is making more income. So if you remember last time, we talked about these various tax brackets, where in the United States, it starts at 10% and it ends all the way at 37%. There's 7 different brackets. A regressive tax would work the opposite, where your first $10,000 of income would be billed at 37%, and anything above $1 million would be taxed at only 10%. These are seen as highly unfair, especially when you think about poorer people or the middle class. To me, they shouldn't be paying a higher percentage than a billionaire. Avoidance. Avoidance is a great thing to know about. It's legal to avoid taxes. This is a legal way that we can lower our tax liability by using legal devices like credits and deductions and exclusions and other loopholes that are part of the tax code. It's a very important thing. It's okay to avoid our taxes. It's not okay to ignore our taxes. So, what can we do as a corporation to help lower our tax liability? One thing that a lot of corporations do, it's called offshoring income. And I'm very apologetic that my face might be blocking that title, but it's called offshoring income. And this chart describes really what's happening. It's when a corporation in a first world country like the United States or the European Union or the UK, they transfer some of their business operations to less developed countries. When Apple, for example, makes their phones in China or Vietnam or other Asian countries, this is exactly what they're doing. This benefits that this helps everybody involved, really, because those less developed countries have more jobs, more GDP. It's good for them there. But the money will eventually come back to Apple in the United States, presumably. This is a good way to lower your liability because those less developed countries, Vietnam, China, all of those places that make so many of our products, they have less stringent rules and regulations, and yet we, in the developed world, are able to take tax benefits. Now, I'll say this is an incredibly complex part of the law and tax strategy. And to be honest, I'm not an expert in this. But this is one tool that a lot of companies use to lower their taxes. To me, it feels a little unfair. I feel like if Apple makes $1 trillion a year, they should be taxed on it, no matter where their operations are. But the tax codes in these various countries disagree with what I have to say. That's normal. I'm used to it. Another thing that companies can do is they can accelerate their depreciation. So when a company acquires a big capital asset like a building or factory equipment, they are able to deduct the depreciation over a period of years. It depends on what type of asset. If it's a building, maybe it's 10 to 30 years. If it's a piece of machinery, maybe it's 3 to 5 years. This technique of accelerating your depreciation, it allows that company to write off, to deduct that cost faster, meaning that you get a larger deduction up front against your taxable income. So many of these strategies are about the timing of the deductions that you take. In one year, maybe you have lower income and you don't need all of those deductions, but you might push it over to the next year where you're expecting more revenue, more income. So by accelerating the depreciation, or theoretically even decelerating your depreciation, you are able to control when those deductions come into play. Again, another very, very complex area of the law with lots of rules, lots of accounting rules that might help a company. I would always recommend looking into them in a little bit more detail than we have time for here. Another thing that a lot of companies do to try to lower their taxable income is to offer employees stock options. This would be income for the employee, but it would also be a deduction for the corporation. Now, when you have a stock option, they usually don't vest for a certain amount of time. And even once they vest, they don't become a reality until those stocks are sold on the open market. So this is an area where there's a lot of wiggle room, a lot of play when it comes to when you're able to take these deductions. Now, if I was an employee of Apple and I received $1 million in stock options, that wouldn't be personal income to me until I sold those stock options. And since Apple tends to go up over time, $1 million now might be $3 million later. Now the corporation can deduct that $1 million straight away, and the person, me, would pay the income tax on that final sales of the stocks for, say, $3 million. This is another device that's used frequently by larger companies. And one last one that I feel like corporations don't think about this enough. I personally think it's an important thing to do with any extra money that we have, is to give charitable donations. C corporations, which should be considered distinct from what they call an S corporation, they are able to deduct charitable donations up to 10% of their taxable income. That's amazing. And if they donate more than that, if they donate 20%, that second 10% will carry over until the next year, over the next 5 years. So here's one way that corporations can do good for the world, but they can also benefit from a good tax deduction. This is something that I hope all corporations do in one way or another, and I do hope that your corporation does, and I hope that together we can try to make the world a better place. I know I said finally on the last slide, but I mean it this time. We mentioned business tax credits a little bit on the last video, and this is a way that we can lower our liability, our tax liability. Again, like I said, most of these credits have some kind of incentive to make the world a better place, some kind of public policy incentive. And by using these tax credits in an efficient way, it can help our corporations, or even us personally, lower our tax rates. Now, it might feel like this is free money, and that's always the best, right? When we can talk about free money, that is the best possible outcome. However, these credits will only work when we spend a lot of money. So if you're in a pharmaceutical or a science corporation, The research that you develop for new pharmaceuticals, new vaccines, new medical devices, some of those monies will trigger a tax credit. Now, again, these are very complex and very technical, and I won't get into the specific rules, but one great strategy to lower your overall tax liability is through the use of credits. And that's it for this video. Our next and final video will discuss a few separate issues when it comes to the world of taxes. You might have gathered by now that taxes are an incredibly complex area of the law, where there's lots of rules that trigger one thing or another thing, and each country has their own specific rules. So how those rules interplay can be especially challenging. It's the kind of thing that when we're talking about a multinational corporation, they often have to deal with tax issues from hundreds of countries. And maybe they don't pay income tax in all of those countries, but they may take deductions from those countries. They may have employees in many countries. I'll stick with Apple, and every Apple store has employees, right? So this is a complex thing, and I certainly wouldn't recommend starting our tax practice with Apple or a massive multinational complex corporation. We'll start small and we'll get bigger. But for now, I will stop and we'll continue this with our final video, Other Issues in Tax Law. Thank you again so much, and I will see you soon. Have a great day.